what they're doing even if they keep things steady, I want to make sure I drive this point home. What they're going to break is me and you. They're going to overheat the U.S. economy. Things are going to get way overheated, meaning they're not going to break something to the downside. They're going to break us with more inflation and higher stock prices and more loosening financial conditions. Not only do they need to keep things steady, they need the high rates. The Fed is implementing these policies that are really hurting me from an inflation perspective. I shouldn't have to participate in an engineered market that isn't based on fundamentals, but they're almost forcing me to. And that's why I'm angry, because when I go to the grocery store, my costs aren't up 3.0%. They're up a lot more than that. And it's really hurting me.
Yeah, no, it's hurting families everywhere. And this is precisely the reason why I decided to start doing this. Because I think this information needs to get out there. It's not out there carried on the mainstream media.
I'm trying to get it out there.
Yeah, we need to democratize this information and get it out to the viewership, because they need to hear this. They need to be in the know.
Right.
So you recently wrote, while everyone is focused on how great earnings are for the Mag 7 and equating this to a strong U.S. economy, for the 384 out of 1,946 companies that make up the Russell 2000 that have reported Q4 earnings, quarter-over-quarter growth is down a jaw-dropping 53%. Right. Maybe things are about to get really bad. Can you speak into this?
Yeah, I'm updating that. 1 second. My Bloomberg is updating. Hold on, I'm gonna tell you what that number is now. Looked at it yesterday. So 1 second, Gary. Give me a second.
Yeah.
All right. So 1,028 of the 1,941 companies that make up the Russell 2000 have reported earnings. That number is now their quarter-over-quarter growth is down 27.44%. Right. That's still jaw-dropping. Now that's in the current earnings season, right? Last earnings season, right? So that's Q4, right? Last earnings season, it's updating now. 1 second. I'm going to tell you, give me a second here. That number was up 1.29%. Here's my point, Gary. The Mag 7 is not the economy. In fact, the stock market's not the economy. The Russell 2000 or the small businesses are the backbone of the U.S. economy. And their earnings are plummeting. Down 27% quarter over quarter is a massive drop, right? That is indicative of a recession that's either here or very near. And clearly, that's not the case, or not, what people are pricing in. Now, the data points clearly suggest nominal GDP 5.8%. We're not near a recession. But if Main Street is entering a recession, that will eventually find its way to Wall Street. And I think data points like this are being ignored by a number of people, to support, elevated stock prices. We can talk about a number of other data points. Since April of 2020, CPI, the increase in the CPI index has far outpaced the increase in wages. So people are just losing buying power, right? Yeah. Prices are up way more than wages are up, even using the CPI, which I think a lot of people would argue is flawed, So I think that's, I don't know if that answers your question, but that's what I'd say to that.
It does. Yeah, it does. And actually, I do have a question coming up on that last point you were just making. So, Gordon, you recently shared that stocks are at all-time highs and home prices are the most unaffordable that they've ever been. What do you see happening with home prices and home affordability over the next 12 to 24 months?
Yeah, I mean, I'll admit we've been right on the fundamentals of the home market. We have not been right on the stock prices, the home builders. But inevitably, I mean, it's very simple. So you have a savings rate at all-time lows. Not all-time, but multi-decade lows. We're near all-time lows. You have credit card debt at like multi-year, multi-decade highs. You have delinquencies now way above credit card delinquencies now way above where they were pre-COVID, and at levels that are screaming recession, right? So people are maxed out on the credit cards. The reality is, like, the COVID money's gone, and home prices are simply unaffordable. I think if you look at so there's two different housing markets, right? You have the new starts market and the existing market. A lot of people look at the existing market, and that's how they derive their thesis. But if you look at the new starts market, right, new home sales, you're talking about home builders that are buying down mortgages, offering discounts, prices are falling. In some geographies, you have significant amounts of inventory starting to hit the market. So overall, I think that home prices are going to drop significantly over the next 12 to 24 months because it's just a simple supply-demand dynamic.
So you see it reverting to the mean in terms of that monthly affordability for the individual, based on their income, et cetera?
Correct, because I think that the Fed has made a number of mistakes recently, which we can go through, that I think is going to result in it is resulting in inflation higher and inflation data points. It just seems like people are like, inflation's down. No, CPI inflation was up year over year and month over month, right? Core CPI, super core CPI is trending at over 8%. And keep in mind, Gary, you know this better than anybody. Like, the Fed's target is not 2%. That's an arbitrary target that was introduced right before Yellen, and she really talked it up. The Fed's mandate is keeping prices stable, which means 0%, right? So they're failing. So my point is, I think that they've made a number of mistakes, which is going to force them to come in and act aggressively. And all this talk about it's an election year, James Carville, has his dings against him. But he said a long time ago, it's the economy, stupid. And what I mean by that is, if the Fed doesn't act, right, and they keep doing what they're doing right now, and inflation resurges higher at some point by mid-year, by the time the election comes around, people are going to be so angry. Like, Biden will lose in a landslide. This is my opinion. I'm not saying I have a political preference. I'm just saying it is the economy, stupid. And the reason why Biden has a record low approval rating is because CPI, or the price of stuff, has far outpaced, right, wages. So people can't afford
it's pretty
stuff.
Simple.
Right? They're talking about all these job additions. You need 2 jobs to afford basically what you got with one job, 4, 5, 6 years ago. So I think people are very frustrated. I'm frustrated. I'm sure you can hear it in my voice.
I can.
But I think that they need to address this because I think the real problem with everything stems from inflation. And I think that all stems from the Fed because the Fed is the only entity that can legally create U.S. dollars out of thin air, right? The government couldn't spend fiscally if the Fed didn't print that, right? And the Treasury couldn't issue bonds if the Fed didn't buy them. If the Fed, I'm sorry, I cut you off, Gary. Think about this, Gary. You know this better than anybody as well. Remember Liz Truss, right, in the UK, right? She had all these grandiose plans to do all of this massive government spending. And you know what happened?
She was removed pretty quickly.
Her central bank said, we're not printing this. You're going to have to go to the market. So what'd she do, Gary? She went to the market. And over one weekend, right? One weekend, rates in the UK shot up. Why? Because the bond vigilantes was just a fancy way of saying bond market investors, mutual funds, pension funds, hedge funds, etc. They said, you know what? We don't want your debt, right? So all of a sudden, interest rates shot up. And literally in a weekend, she was out of office. She was out of office. Somebody had to come in who had much more conservative spending plans, and that solved it, right? It didn't solve it overall, but it was a big. So my point is, the Fed could solve this tomorrow by stopping the printing press, but they're not.
Yeah. Well, the climate just doesn't seem politically viable for that. Nobody wants to go into austerity mode. The people are clamoring. If they stopped with one of my questions to you, and we can get to it in a moment, but what happens if they stop deficit spending at the $3 trillion level that they're at? I mean, if they do, wouldn't the economy just collapse? So
not necessarily. The stock market would collapse, but the stock market is not the economy. In 2020, I think 2020 or 2020 to 2021, you had like a 40% drawdown in the QQQs of the NASDAQ, and the economy didn't enter recession. And I think the other time frame that happened, I think, was 2006 to 2007. The stock market is not the economy. The wealthiest 10% own 93% of stocks. So when Biden and Trump before him come out and boast about the stock market, really what they're boasting about is it's almost like a reverse Robin Hood, where the masses are getting inflation, higher prices, lower quality of life, where the wealthiest 10% who are already, recklessly wealthy are getting even wealthier. The stock market is not the economy. So, would there be tough things that companies do? Yeah, but they're already doing. They're already cutting jobs. Again, we can talk about the job market. It's not bad yet, but they're starting to cut jobs. But I think that I'll stop there.
Well, I just want to point out though that with the age of the boomers and their wealth and their need to take distributions at their ages, and with the level of the stock market, aren't they driving a decent amount of the tax revenues from the stock market? If the stock market drops, wouldn't tax revenues drop?
You could that's possible, but there's a bunch of different factors that go into that. But I'll take a step back and take a 2,000-foot up view. The great Charlie Munger, right, who I think we all like, or maybe a lot of us do. He said the only thing worse than inflation is nuclear war, right? And this is a man who, God rest his soul, recently passed, but was very old and has been through a number of cycles. A lot of these economists and people who are respected as being mouthpieces for the Fed, for instance, like Nick Timiraos, whatever, I don't know how to pronounce his last name, sorry, but at the Wall Street Journal, right? He started to look at the 3-month annualized CPI number to argue that, they should cut rates. The problem with that is in 2021, that 3-month number was annualizing at 10%. He wasn't using that number at the time to call for rate hikes, but now he's cherry picking and so my point is, the guys who have seen and been through cycles, right? We haven't had a down cycle since what?
15
2009?
years. Yeah.
A lot of the portfolio managers today have never seen a down market. They know how ugly inflation is. So my point is, I think you need to fight inflation and fight it seriously, and the Fed just simply isn't doing that.
Yeah. So, and that's a fair point, I think. So, and we're going to get into the Fed and interest rates here in a moment, but we were talking about real estate, and I have a couple of questions regarding banking for you. How much of a problem for the banks is the commercial real estate issues and all that underwater paper that they're holding?
Yeah, so I think that the commercial real estate issue is a real problem. The question is, what is the Fed going to do to bail them out? Last SVB banking crisis, right? You had, a number of banks that engaged in reckless activity, right? They just simply didn't measure or manage for duration risk. That's banking 101, Gary. You know that. I mean, these banks should have been allowed to fail. And what did the Fed do? They came out and told us, we need to provide these bailouts because if we don't, a number of, small depositors are going to be hurt. And then we later found out they bailed out a bunch of people who had like $1 billion and higher deposits. It was a complete farce. So my point is, I say that to say, I don't know how big of an issue this is going to be near term because you may have a Fed willing to come in alongside Janet Yellen and bail these guys out. But the problem is, inflation is inflecting higher again. So if they come out and listen, Gary, in 2023, right, there were a number of economic indicators that were showing the U.S. economy was overheating. For instance, you had very strong job ads in January and February of 2023, right? The market was overheating. The SVB banking crisis bailed the Fed out, right? Without that crisis, right, the market would have overheated, inflation would have inflected higher, and we would have had a disaster of a stock market year in 2023. Same thing in 2020, early this year, or late last year, I'm sorry, right? You had what I call the term premium mania, if you will, where rates late last year imploded, right? Which was another, bailing of the Fed out of a market that was overheating. They positioned themselves into a corner where if you have another crisis, i.e. a CRE crisis, commercial real estate crisis, and they have to come in and bail out, that's going to, I think, put a fire behind inflation, be a tailwind to inflation. I think overall it's going to be a very bad thing. Over a short period of time, I think it'll be a bad thing this year.
Okay, let's steer over to interest rates and the Fed. And, the market's been talking about, as of last year, or going in just a couple of months ago, they were saying six rate cuts for 2024. Then it dropped to 3 to 4 rate cuts. Now there's really a lot of speculation that it's going to hold steady for quite some time. Do they run a risk or a higher risk of breaking something by keeping rates elevated or steady? Is the economy structurally sound enough, despite the current debt levels and deficit levels, to handle the higher rates indefinitely?
Yeah, that's a good question. They were supposed to cut rates last year, right? The market was pricing in rate cuts last year. They didn't. And we've had animal spirits unleashed, stocks going to the moon, financial conditions loosening the most ever, and inflation reverting higher. That's with them keeping rates steady last year, right? So when you say break something, no, that's in my view, and I don't mean to belittle, but that's the exact opposite, wrong way to think in my view. What they're doing even if they keep things steady, I want to make sure I drive this point home. What they're going to break is me and you. They're going to overheat the U.S. economy. Things are going to get way overheated, meaning they're not going to break something to the downside. They're going to break us with more inflation and higher stock prices and more loosening financial conditions. Not only do they need to keep things steady, they need to hike rates. I want to highlight something to you. So the Fed's view that they need to do normalization cuts because real rates are increasingly restrictive is just flawed and wrong. Think about this, Gary. When the government runs 6+% fiscal deficits in an economy that has full employment, where both households and corporations have locked in low borrowing costs, the increase in interest rates seen so far is clearly not enough to bring inflation back down to 2%. What the Fed needs to do is they need to talk about, in their dot plots, they need to talk about rate cuts and not raising rates. They need to raise the neutral rate, right? Because there's clear evidence that their neutral rate, i.e. where they're at right now, is not clearly restrictive. And if they do that, that will temper animal spirits. But that's not what they're saying they're going to do. Now, keep in mind, the past few days, we've had a number of Fed members come out and talk about keeping things steady. But I think the inflation data we get in February in March for February, I think is going to be surprisingly high. And no, I don't think they're breaking something. In fact, I don't think they're doing nearly enough. Evidenced by the data points I mentioned. Record corporate bond, investment grade bond issuance, nominal GDP 5.8%, savings rate all time low, et cetera. And the fact that jobs are trending at 353 when the replacement rate of jobs in the U.S. economy is 50 to 90,000. We're nowhere near the red alarm level of job growth. So there's no metric saying they should be cutting rates. Every metric, Gary, is saying they should be raising rates. Yet they're talking about still keeping rates steady when they did that last year, and we had a release of animal spirits, which is now driving inflation higher. They're making a big mistake by doing this. Keeping rates steady.
Yeah, I hear you loud and clear. I think the Main Street is believing that it needs to be lowered, but I hear you loud and clear.
But why do they believe that?
Yeah, because they're being told that.
Right.
Yeah.
Like the Nick Timorosis at the Wall Street Journal saying you should look at the 3-year annualized CPI rate and arguing that they should cut rate. That's ridiculous because again, that rate was like 10% in 2021. He wasn't saying the Fed should hike rates. In fact, during that time, he was saying they should cut rates. So people are just cherry picking data points to support what's coming out of the Fed versus looking at the data. And the problem with this is we're suffering. There's real consequences to these unelected bureaucrats making huge mistakes over and over and over again.
Yeah.
Let me take a step back. Let me tell you how reckless this Fed is, right? So when COVID happened, right, they did QE infinity, right? And after retail sales were not back to trend, 15% above trend. They were 15% above trend. It took a few months, right? During the GFC, that took like 3 years for retail sales to get back to trend. 2000 bubble, that took like 5 years. After retail sales were back above trend and we had vaccine confirmation, they did another $2.5 trillion in monetary stimulus. Mm-hmm. That is reckless. That is why we're having this inflation. That is why Biden's approval rating is an all-time low, and likely why Trump lost the election. Because people are just so frustrated. Whoever's in office, they say we want something different because they can't afford anything, and it's only getting worse. Yeah. The Fed is the problem. They are the fundamental and primary problem. Clearly, Gary, it's not supply chains, right? Because if it was supply chains, which every politician was saying, right, when supply chains corrected, which they have, prices would have corrected. They haven't. Prices have just gone straight up. So clearly it wasn't supply chain. This is a Fed problem. and it needs to be nipped in the bud before, like Munger said, inflation, the only thing being worse, nuclear war. So what does that mean? Nations fall on inflation. We need to get this problem solved.